Two undervalued stocks to consider for May of 2024. This is a series that I do every month, trying to find two undervalued stocks to share on YouTube. I have more than two. I have been finding a lot of deals recently, so I'm going to be doing more and more of these videos for May of 2024. But in this video, I have two stocks I'm going to talk about. I'm going to try to keep it very, very short and give you as much value as I can in a short period of time. So if you do enjoy these videos, all I ask, if you could please press the like button and maybe consider subscribing if you're new to the channel. Now, the first stock that I'm going to talk about, and this is the first time I discuss a mega cap stock in my series of the two undervalued stocks to consider, and this stock is Meta. Meta is sitting at $427 per share. It's down around 14% over the last months, and it's trying to fill in this gap, and it created another gap. I believe we could realistically fill in the gap around $406 per share. But the main argument against owning Meta, this is the main pushback I got. And this is that if you look at the chart, Meta was trading around $150 last year or a few months ago, $150 to $200. So it was trading at $150. Let's say we did not buy it at $150, and now it's sitting at $427. So why would we buy it at $427 if it was sitting at $100 just a few months ago? And this is something that I call, anchoring bias, or anchoring in general in the stock market. You see something trading at $100, you don't buy it because it went to $120, because you saw it at $100. But what if when it went from $100 to $120, the EPS per share or earnings per share went up 100%. In this case, at $120, the stock would be cheaper than it was at $100 per share. But we always get influenced by the price and not the value. Even though Meta went up so much, I still believe Meta is presenting a decent buying opportunity, a decent value proposition at this price. And if you don't look at this chart and you look at all the numbers I'm going to give you, you're going to say, oh, Meta is undervalued. But a lot of you will not consider buying it just because you've seen it trade at $100 per share a few months ago. And in my opinion, this is a very, very big mistake. I bought many stocks at 52-week highs, and the value, well, it was improving, and this is why I bought them, and I did make pretty good money on them. But this is the thing with Meta. The last earnings report wasn't bad at all. 471 versus 432. It was actually pretty amazing for earnings per share. Also, they did a slight beat on revenue, which was good. The market is freaking out about CapEx again. This is one of the reasons why the stock went to $120 or $100 per share, even $89 per share, I think. Because just the market was freaking out that Zuckerberg is spending a lot of money on things that don't make them money, and they might make them money in the future, but they're not making them money in the present. And the market was freaking out. So he did pull back on CapEx. Once he pulled back on CapEx, did a lot of buybacks. He created massive value for shareholders, buying back stock at $150, $180, $200 per share. And he did amazingly well. But now he's increasing CapEx again. Now for 2023, CapEx was $28 billion. And he projects CapEx to be around $35 to $40 billion. So this is a massive, massive jump, over a $10 billion increase in CapEx, because he's trying to invest in AI and in many different things. And I have to say, I'm not a big fan of that stuff. But maybe this stuff will turn profitable. But if you look at the core business of Meta, the core business itself is undervalued. And these investments they are making, they could be call options on the future. I understand they are very expensive call options, but if they do work out, they could do amazingly well. But even though, they're doing that stuff, the business model of Meta itself can support such CapEx spending, because the business model is amazing, and they have massive, resilient, recurring free cash flow for the company. Daily active people has continued to grow, and this is pretty good stuff. The company still has a good balance sheet, over $57 billion of cash, and total long-term debt is around $18 billion. So Mark Zuckerberg has a lot of money to buy back stock if the stock goes down. And even after spending $40 billion on CapEx, the company is still generating $46 billion of free cash flow. This is what I'm talking about. That if Meta was some kind of startup and they're diluting shareholders to invest in things that don't make them money, then I would understand that this is very, very bad. But even after putting in $40 billion in CapEx, the company is still generating $46 billion expected for 2024, and is expected to continue to $54 billion, $60, $68 billion. So even with the massive CapEx spending, Meta is still trading at a 4.3% free cash flow yield. Without the CapEx, it would be like, 7 or 8% free cash flow yield. It's pretty amazing stuff. So my point is that yes, such things are bad if they don't turn profitable. If they turn profitable, it's amazing. But if they don't turn profitable, you are not paying an expensive price for Meta at 4.3% free cash flow yield or around 21 times earnings for a company that has massive, massive margins and has continued to grow around 18% a year in terms of earnings per share. And this is the estimate for Meta. I posted this on my Twitter account. It's 33% for 2024, which I believe is achievable. 2025, 2026, 2027 is around 15% annual. So in total, if you're buying Meta today and they do hit the 15% after 2024, which I believe is easily achievable with a combination of buybacks and growth, in 2027, you're pretty much paying right now around 14.9 times earnings of 2027, which I believe if we get around 15% average for Meta, and if Meta does not experience a multiple contraction, and from where it's trading at 21 times earnings, with the massive capex they're doing, they could save a lot on capex, but they're not doing it. So 21 times earnings for a company with massive margins that's growing 15% in earnings, and you have the TikTok ban that could be amazing for Meta if it does happen. You have the AI stuff and many different investments that could turn out being amazing, a lot of call options. But just the business itself, I'm not seeing a multiple contraction from 20 to 21 times earnings. So if the company does grow earnings per share 15%, I would expect the return of the stock to be pretty close to 15% if we do not experience a multiple contraction. And this is 15% excluding a TikTok ban, like a complete just ban of TikTok, which could be amazing for Meta. And this is excluding any of the AI investments or CapEx investments turning profitable or something amazing coming out of them that could give the company even a multiple expansion instead of a contraction. So this is what I'm seeing with Meta. If you ignore the stock chart, if you ignore how much the stock is up, you look at the fundamentals are amazing, even though the stock went up. But if you're not influenced by the price and you focus on the value, I think Meta is offering a good buying opportunity at this price. And this is why I decided to include it in my 2 undervalued stocks. Even though I talk about smaller cap stocks, for mega cap stock, I think Meta is presenting a good buying opportunity. Now for the second stock, which I talked about, and this is one of the most requested stocks. What do you think about this stock? Can you update me on your opinion? And this stock is a stock called Ulta Beauty. I'm going to talk about the main pushback or the main argument I get against Ulta Beauty, which is that we're going into a recession and things are very, very bad. I'm going to discuss it in the video. If you give me some time, I'm going to tell you why I believe most of that stuff is most likely priced in within the company. But looking at Ulta Beauty, it had a massive, massive decline. I talked about it last year. It was an amazing buying opportunity. The stock went to $579 per share, and now it's back at $404 per share. I mean, massive 360 for the stock. But this is the way the stock market is. Sometimes, most of you are familiar with the companies. They have beauty stores, women go there, and people in general, whoever wants to go there, they buy makeup stuff, they buy many different things. They have many different price points. So if people cannot afford something on the higher end, they can buy something at the lower end. They have a massive cult following in the United States. A lot of you know that stuff. Over 95% of members are ultimate Ulta reward members, and they get points for shopping there, and they have a massive loyalty program. Amazon has been there for a long time in terms of the beauty category for people to order, yet people still go to Ulta Beauty, they still go to Sephora to buy that stuff, even though Amazon is still existing. So the whole thing that Amazon is taking over, yes, it is taking over, but people have been going there for years, and Amazon has been there for years, and they're continuing to go there for years. And you could see it from the comp sales growth, you could see it from the same store sales growth, you could see it from the free cash flow growth, from the earnings per share growth, from the revenue growth. So people are still going to Ulta Beauty. And in terms of the last earnings report, it wasn't bad at all, but guidance wasn't the best. And as you could guess, most retailers have been starting to lower their guidance for 2024. And retailers have been suffering pretty much since early 2023. But even, retailers like BJ's Wholesale Club, which I talked about, has been suffering somewhat. Costco has been seeing some pullbacks. Even Walmart saw some pullbacks. McDonald's is seeing pullbacks, even though it's a cheap place and people just can't, some of them are not eating there. And even, places like Starbucks coffee, Starbucks stuff, they're also facing stuff. They just reported earnings, and things are very bad for Starbucks in terms of same-store sale growth. So retail and stuff like that in general, most of them are suffering, even Target a little bit. And the same thing with Ulta Beauty. But even with that, they're still expecting comparable sales, 4 to 5%. Earnings per share growth is around 1 or 2%, which is almost nothing. Share repurchases up to $1 billion. And they are trying to expand in Mexico. They partnered with someone that's popular over there, and they're trying to expand their stores into Mexico. And this could be another area for growth for Ulta Beauty. Now, in terms of the whole thing with Ulta Beauty is, the way it's priced in, I'm going to tell you. But for earnings per share growth, it's only around 2% for 2025. And this is, again, as I talked about, which is fiscal year 2024, by the way. But I did talk about this, that most retailers are suffering. Most retailers are just suffering in terms of this period. Now, the stock is priced like it's never going to grow again. And I'm more with the analysts that I believe over the long term, Ulta's earnings per share growth will be above 10%. Most likely 10%, 11%, 12%. This is what it was even before COVID. I'm trying to go back, but it's not letting me do it. I don't know why. But even before COVID, I could put up a chart. They used to grow earnings per share 10, 15, 20, 25%. I'm not saying we're going to get back to 25%, but with their expansion into Mexico, I would easily expect 10, 12, maybe 12 to 13% earnings per share growth. But the market is pretty much saying that Ulta Beauty is never going to grow again, and I don't personally believe it. And for Ulta Beauty, you're getting a company with high return on capital. Return on capital is pretty close to 40%. You're getting a company with $766 million of cash and no long-term debt, which they put them in a position of power to buy back stock. So they have $766 million of cash, no long-term debt, and they have around $250 million of quarterly free cash flow to buy back stock. Now, their buyback program for 2024 is $1 billion. They already have $766 million, and they have an extra $250 million every quarter. So in total for 2024, they're going to have pretty close to $1.7 billion to buy back stock. And the company has been a buyer of its own stock on weakness. Whenever the stock goes down, they do buy back more stock than usual, like they did in 2023, and like they did somewhat so far in 2024, but they buy 5, 6, 7% of the market cap. So for me, if we do have a recession, and if we do have the stock continuing to go down, this is going to create massive value for long-term investors. If Ulta Beauty is in a position to buy back stock, and it's in an amazing position because they still have a line of credits, they haven't borrowed on it. They borrowed like $20 million a few quarters ago, they paid it off. So they're not borrowed on it. They have $766 million of cash and no long-term debt, and very good tailwinds for the company and expansion to Mexico. I would say around 12-13% earnings per share growth. Now you're getting this company pretty close to 15 times earnings. And 15 times earnings has been rock bottom for the company. This is where it went last year, around 14 times, and it bounced. And the only time it went below 15 times earnings was in March 2020. Before that, it traded at a mean of 27 times. Now, back then, it used to grow much faster. But I believe 15 times earnings for a company that has high return on capital and no long-term debt and massive prospects and amazing balance sheet and buyback stock, I think 15 times earnings is basically saying that Ulta Beauty is never going to grow again in terms of revenues or earnings per share. I mean, companies with very high debt that have 0% growth or declining, they're trading at 9 and 10 and 11 times earnings in this market. So for a company like Ulta Beauty with no debt, I think 15 times is basically saying that the company is never going to grow again. And I personally disagree with this, pricing in terms of the market. And I think at 15 times earnings, we'll most likely have priced in some kind of a decline for the business or some kind of recession, as a lot of you might want to say. But the way I think about it is people are expecting a recession. They are expecting a slowdown. So a lot of the retail stocks are crashing, and Ulta Beauty is crashing. It's going down. And these stocks will most likely bottom before the recession becomes obvious. So by the time everyone is calling for a recession and recession becomes obvious, I believe Ulta Beauty will already be starting to go up because they are already priced in such expectations. So the way Ulta Beauty is priced in, yes, it might go down a little bit more, but it's in an amazing position to buy back stock. And with all these things at 15 times earnings, I think we could get 12 to 13% after 2025, which is fiscal year 2024. Over the long term, I think we can get 12 to 13% earnings per share growth. And if we do get 12 to 13% earnings per share growth, I would personally expect the company to go much, much more than 15 times earnings, maybe 17 to 18 times earnings. This is what happened. We had the recession fears last year. The stock went to 14 times. Then it bounced all the way to 20 times earnings. I'm not saying it's going to go to 20 times, but if we have 12 to 13% earnings per share growth, you have like a 6.5% free cash flow yield. So you're getting 6.5%. The company has to grow 6 or 7% for buybacks and some growth. That's like 12, 13%. And you could get a multiple expansion, which I believe could offer more than 15% annual on Ulta Beauty, or over a double over the next 5 years for Ulta Beauty and Meta stock. And this is why I decided to include them in the video. Now, both of them look very, very weak on the charts. They might go lower a little bit, but Meta is in an amazing position to buy back stock, and Ulta Beauty is in even better position with no debt and massive free cash flow and a cash position to buy back stock. So if the stock goes down, it's good news. I would rather the company buy back stock at a lower price than at a much higher price. And this is just my opinion on these stocks. This is what I think of them. It wasn't financial advice, of course. Thank you very much for watching the video. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.